Hey traders, so I've been requested to make a lesson on when will I not take trades. I believe I've talked about this before as well. So like under which market condition, structure, ugly price movement, how does it look like visually? So there's a few scenario where I won't be looking to take any trade. First one is I don't consolidation. So if let's say, just to give you a context, so if let's say I look at gold right now, and let me find an example. So gold not really okay, we've been fairly on an uptrend, so there's not much example here, but yeah, something like this. So when I see price gets into an ugly consolidation means I don't, even if I know price is inside a range, price is forming a higher range, sorry, a bigger range, I'll try to avoid getting into all these minor levels. Remember when I talk about the importance of stepping sideways when price is forming an irregular range, that means we don't really respect the high, we don't really respect the low. The same thing goes to here. If you try to trade this, even if you short into an intermediate structure like this, you're either going to get swept out, or you're either going to get faked out at the low. You see, if let's say you're looking at a range like this, let's say you drop down onto the lower time frame, you're trying to trade ranges like this, you will most likely lose money. You know why? Because market is just irregular. If you look at the high, it doesn't have an equal high. See, slightly lower, we don't really form a support. Most of the trading problems comes from traders getting into the lower time frame without understanding the high time frame context. So we go back to the screenshot just now. Sorry, go back to this one. So just remember, if I today look at the daily and I see price forming consolidation like this, I just won't be involved. I much prefer participating after seeing a clear breakout. So if let's say the consolidation looks very ugly, even on a daily, if you see a market getting very ugly on a daily, don't even bother looking at the lower time frame. Alright, so I'll give you one example as well. My strategy, my trading style, or we can call it my edge, revolves around trading a clear TPF, and especially I need to get involved with a beautiful price position. Let's put it this way. Price position will determine almost everything. So when it comes to profitability, my edge has always been revolved around getting into very good entry, and that also is not easy because it requires a lot of patience. So what does it mean by a beautiful price position? So if let's say I'm looking to go long, I'm either going to see a very clean uptrend with a clear TPF or clear BNR, or I'm not going to get in. If I see a pro trend like this, I don't get involved. I still remember times where gold went into a parabolic uptrend for the past many months. There are plenty of traders, including some of you, ask me, why don't you look to just chase it? Like wherever you buy, you just make money. But the key thing is, not all the money belongs to you. Not all opportunity belongs to you. A common problem will always be traders think, hey Neil, I'm seeing a clean TPF, should I take it? Just because price forms a clean TPF, it doesn't mean it fits into the overall system. Because why? Because the pattern itself, like TPF, BNR, is just one small aspect. It's one element. What makes a setup A plus is the evidence you collect on the higher time frame. If let's say today someone come to me or any of you, I ask you, hey, why are you looking to go long? If the only thing you tell me is, oh, I saw a TPF here. What else? Nothing. I just saw a TPF. That's why I thought of getting into a position. And that's the big separation between the elite trader and some of our really good traders inside our trade club. We all know who they are. And some of you who are less profitable. Why? because you're always looking to snatch every single opportunity. I'll give you one example. Okay, let's say gold here on a daily. Some of you actually drop down onto the lower time frame and try to trade a TPF like this. On gold, it worked. Why? Because market was on a parabolic uptrend. If you try to chase this kind of setup on other pairs, you probably will fail. So the context really matters. Okay, you only trade setup that you clearly know what you're doing. Okay, so if let's say I'm looking at this price section here. If I'm looking at this price section, I'll say, assuming if we are looking to go long, okay, you can say this. I'm looking to go long because price have faked out this low. At the same time, we recovered back above this key support zone here. That itself is one thesis, is one important thesis. We have a strong fake out at this 1171 zone. Price is breaking and holding above this 1176. And price right now is tested and still rejecting this level. Then you already have two evidence. First one, price faking out this major level. Second thing, price holding strong above this major level. Then only you drop down onto the lower time frame and you say, hey, I'm seeing probably a TPF here at 1208 and I'm looking to trade it to the upside. I'm seeing a bull flag after this significant fake out TPF and I'm looking to trade this bull flag. This would naturally be an A+ setup because you know why? You have already get all the answer that you wanted. So back to it, price position would determine almost every single thing. If market is not giving me a good pullback, I won't take it because I treat trading like a business. Every business requires a good deal, and a good deal comes from giving you a good price. Without having a good price as your entry, it will never be a good deal. Alright, if it's not a good deal, it's not going to be a A+ setup. Okay, the next one will be context matters. So what kind of setup do we normally trade? TPF and BNR and range, right? So all these three setups require one important thing if you really think about it, which is key level entry. That means what? We try not to get in on really minor level. What's minor level? Let's say you're looking at this chart and you say, I want to get in on this BNR. Many of you again ignore the fact that this setup actually succeed, but this kind of entry most of the time will result in losses. Getting into key level means if I were to trade a TPF, I want to see price faking out this key level and giving me the best possible scenario. The same thing, if I'm looking to trade a BNR, I want to make sure price breaks above this key high before I get into the trade. I don't trade BNR on the lower time frame. Why? Because I realize the success rate is extremely low. And at the same time, it's all about simplifying your setups. The more you learn how to simplify your setups, the more likely you will become profitable. So let's move to, let's get into euro dollar, okay, and talk about why we've been bullish on this and why this is not the best timing to go long. So I'll paste this here. So remember if all of you remember, we started taking long on Eurodollar. Some of you went in really aggressive at 103.74 because you realized that price was forming a potential TPF here, 111. And some of you will say, if you buy here is aggressive. Not really. You know why? Because we have already get all the evidences that we wanted. If you go to the 2-day chart, or let me see, or even on the weekly. Yeah, here you go. So we have price tapping, let's say faking out this key level here, and it's attempting to hold above this zone. You see that 103.57. Once you tell me this, I'll immediately say, hey, that's definitely an A+ setup. Because why? Price position is good, high time frame evidence, and risk reward, the potential upside is massive. So when Eurodollar actually broke above that 105.10, as much as I wanted to buy, but this entire thing, I just missed out all of them. I missed out every single thing here, and it goes back to our second point. Price position will determine everything. Not all opportunity belongs to you. Some of you always have the mentality of, oh, I missed out here. Where should I go in? Entries are always like a staircase, one step at a time, one step at a time. So assuming if you're looking to go long here, price broke above, where will be the following entry? It will either be here or here. If assuming you've missed out this one, and also this one, where will be the following entry? It will be this one. Once you start taking trading like a staircase process, layer by layer, as long as you learn how to identify clear market structure direction, you're almost correct. And yesterday I had a call with one of our mentees inside our trade club. He was fairly new, and I talk about the concept of how do you use invalidation point to almost simplify or almost eliminate 90% of your headaches. Most traders lose money because they don't have a good grasp of the market direction and structure. So the key to identifying market structure and market direction is to have an invalidation point. That would take off so much headaches. Imagine if every day you go to the chart, you drop down onto the 2 hour and you try to crack the code and say, am I looking to buy or sell? That's very difficult and it's not sustainable. What's the easiest way to identify market direction? Is to go to the chart, ask yourself, where's the most important support zone? If you're looking to go long, it will be here. So your conclusion will be, as long as price holds above this 1156 zone, I will remain bullish. That means all you do is you look to buy. You don't even look to sell. So if let's say price is not around this zone, you just walk away. Or if price have broken significantly to the upside, you just look for the next level. But you at least eliminated the headaches of, should I short? No. Unless price do this, then you can go short. And I hope this video simplifies a lot of things for all of you. And yeah, I'll talk to you later. Any questions, feel free to ask inside the Q&As or the focus group inside the communication group. Talk to you later. Bye-bye.